Picture this. You're standing at your mailbox, and you pull out an envelope from Centrelink. Your hands are slightly shaking because you know what's inside. You've been waiting for weeks, maybe even months. You tear it open, scan through the first few lines, and then you see it. That one word that makes your stomach drop: rejected. All those hours spent gathering paperwork, all those sleepless nights worrying about your financial future, all that time waiting for an answer, and this is what you get: a rejection letter. But here's what's absolutely mind-blowing. There's one simple mistake that's behind thousands and thousands of these rejections every single year. And once I tell you what it is, you're going to be shocked at how easily it could have been avoided. Welcome to my channel. If you're new here, I help everyday Australians cut through the confusion and red tape of dealing with Centrelink. I've spent years in this space, and I've seen the same problems come up again and again. Today, I'm going to reveal the #1 reason why pension applications get rejected, even when people absolutely qualify for support. And more importantly, I'm going to show you exactly how to make sure this doesn't happen to you. Let's be honest for a second. Dealing with Centrelink is nobody's idea of a good time. The forms are complicated, the rules seem to change constantly, and just trying to get someone on the phone can take hours. But when your pension application gets rejected, it's not just an inconvenience, it's a crisis. Think about what this rejection really means for you. First off, you've just lost weeks or potentially months of your life. If you're in a position where you desperately need that pension to cover your rent, your groceries, your medical bills, every single day without that support matters. You might be dipping into whatever savings you have left, or worse, going without things you actually need. Then there's the whole nightmare of having to start over. You don't just get to fix one little thing and resubmit. No, you're often looking at going through the entire application process from scratch. That means more forms, more documentation, more waiting, more stress. We're talking about another month or 2 months or even longer before you see a single dollar. And let's talk about the emotional side of this, because it's real. When you're already in a vulnerable position, already stressed about money, already worried about your future, getting that rejection letter feels like a punch to the gut. You start questioning everything. Did I do something wrong? Does the government think I'm lying? Am I ever going to get the help I need? The anxiety builds up, the frustration mounts, and you feel like the entire system is designed to keep you out rather than help you. Now, you might be sitting there thinking, well, rejections probably happen because people don't meet the basic requirements, right? Like they're too young, or they're earning too much money, or they have too many assets. And sure, those are definitely reasons why some applications get knocked back. But here's the thing that's going to surprise you. I've worked with countless people who tick every single box. They're the right age, their income is below the threshold, their assets are within the limits. They should be getting approved without any issues, but they still get rejected. Why? Because of one specific type of error that Centrelink sees over and over and over again. Are you ready for this? The single biggest mistake that causes preventable pension rejections is incomplete or inconsistent asset declarations. I know that might sound like boring technical jargon, but stick with me because this is absolutely critical to understand. When you apply for any Centrelink pension, whether it's the age pension or the disability support pension, they need to know everything about your financial situation. And I mean everything. They want to see every asset you own, every dollar in every bank account, every investment, every piece of property, every vehicle, everything that has monetary value. The asset test exists to make sure that taxpayer money goes to the people who genuinely need it most. So, where do people mess up? Let me break this down for you. Some people underreport their assets because they're trying to be humble or modest. They think, oh, that old car isn't worth mentioning, or that small investment account doesn't really count. Other people genuinely don't understand what Centrelink considers an asset. They make assumptions about what needs to be included and what doesn't. And then there are people who provide information that doesn't line up with the records that Centrelink already has access to through other government agencies and banks. Sometimes folks simply forget about certain assets. Other times they estimate values instead of getting accurate figures. Both of these approaches can absolutely sink your application. Let me paint you a picture of how this plays out in real life. You've got a caravan sitting in your backyard that you haven't used in 5 years. You don't even think about it anymore. But Centrelink considers it an asset. You co-own an investment property with your sibling, and you only own 50% of it, so you figure you only need to declare half the value, or maybe not declare it at all. Wrong. You lent $20,000 to your daughter to help her buy a house. And in your mind, that's just family helping family. It's not like it's sitting in your bank account earning interest. But from Centrelink's perspective, that's absolutely an asset because that money is owed to you. The situation gets even more complicated when your asset information doesn't match up with data that Centrelink receives from the Australian Taxation Office, banks, and other government agencies. And trust me, they have access to a massive amount of information through data matching programs. They're cross-checking everything. If you declare $15,000 in savings, but your bank statements show $30,000, alarm bells start ringing. If you don't mention your investment property, but it shows up clear as day on your tax return, that's a major inconsistency. Even if these mismatches are completely honest mistakes, even if you had no intention of hiding anything, they can lead to immediate rejection of your application. Let me tell you about someone I'll call Margaret. She was 67 years old, had just retired after decades of working as a teacher, and she thought she'd done everything perfectly with her pension application. She listed her primary residence, her car, her savings account. Everything seemed straightforward. Then her application got rejected. She was devastated. She couldn't understand what had gone wrong. It turned out that Margaret had forgotten to include her husband's superannuation balance in the asset declaration. Now, even though the super was in his name and he couldn't even access it yet, it still counted as a household asset for pension purposes. This one oversight, this one forgotten item, cost her months of pension payments while she fought through the appeals process. Or think about Thomas. He declared all his assets, so he thought he was being completely honest. But he used estimated values instead of getting proper valuations. He guessed his car was worth about $10,000, but when Centrelink did their assessment, they valued it at $18,000. He figured his boat was worth around $5,000, but the actual market value was $12,000. These seemingly small discrepancies added up fast. When Centrelink calculated his total assets, he appeared to be over the threshold. Application rejected. If Thomas had just taken the time to get accurate valuations before applying, he would have known exactly where he stood. He could have either adjusted his situation or provided proper documentation to support lower values. So how do you avoid falling into this trap? The answer is thorough preparation before you even think about submitting that application. You need to create a comprehensive list of absolutely every asset you and your partner own. And when I say everything, I mean everything. Start with your home and its current market value. Include every vehicle you own, whether it's a car, motorcycle, boat, caravan, or trailer. List every single bank account, term deposit, and savings account, even that old account you opened 20 years ago that you barely remember exists. Document all your shares, managed investments, and other financial investments. Include your superannuation, even if you haven't retired yet. Don't forget any investment properties or land you own. If you're self-employed or own a business, those business assets need to be on the list too. Personal items worth more than $5,000 like jewelry, artwork, or collectibles, those count as well. Any money that other people owe you needs to be declared. Even funeral bonds and prepaid funeral plans go on the list. Next, you need to get accurate current valuations for all your significant assets. Don't guess. Don't estimate based on what you paid 5 or 10 years ago. For vehicles, use resources like Redbook to get proper market valuations. For property, consider getting a professional valuation or, at the very least, look at recent sales of comparable properties in your area. For shares and investments, use current market values, not what you originally invested. Then comes the documentation phase. Gather bank statements for all your accounts covering the relevant period. Get your superannuation statements, property valuations, vehicle registration papers, share portfolio statements. If you've lent money to others, you need loan agreements. Everything must be provable and verifiable. You also need to understand what's exempt and what's not. Generally, your primary home is exempt from the assets test if you own it and live in it, but investment properties definitely are not exempt. Some personal items under certain values are exempt. Knowing these rules inside and out helps you complete your application accurately. Be completely honest and transparent about everything. If you're unsure whether something counts as an asset, include it anyway and let Centrelink make the determination. It's far better to over-disclose than to under-disclose. An asset that turns out to be exempt won't hurt your application, but an undisclosed asset that should have been declared will absolutely destroy it. Make sure there's consistency across all your documentation. If your tax return shows certain income or assets, your Centrelink application needs to reflect exactly the same information. If your bank statements show larger balances than what you've declared, you need to explain why. Consistency is absolutely key because Centrelink will check and they will find discrepancies. Here's something else that catches people completely off guard. The asset test has thresholds and they change periodically. For a single homeowner, the asset threshold is around $614,000. For a couple who are homeowners, it's around $919,500. Non-homeowners have higher thresholds. If your assets are anywhere close to these limits, even a small error in valuation or one forgotten asset can push you over the threshold and result in rejection. But there's another layer to consider. Even if you're under the threshold, the amount of pension you receive is directly affected by your asset levels. The more assets you have, the less pension you'll receive, calculated on a sliding scale. This is exactly why accuracy matters so much. If you overestimate, it costs you money. If you underestimate, you risk rejection and potentially even fraud allegations. What should you do if your application has already been rejected because of asset declaration issues? First, don't panic. You have options available. You can request a review of the decision, which means Centrelink will look at your case again with fresh eyes. You can provide additional documentation or corrections to your asset declarations. If that doesn't work, you can appeal to the Administrative Appeals Tribunal. But honestly, prevention is so much better than trying to fix a rejection after the fact. Let me give you some additional tips that will strengthen your application beyond just getting the asset declaration right. Make sure you apply at the right time. For the age pension, you can claim up to 13 weeks before you reach pension age. Don't wait until you're in a desperate financial situation. Start the process early and give yourself a buffer. Keep copies of absolutely everything you submit. If something goes missing in the system or gets questioned later, you'll have your own records to back everything up. Follow up regularly with Centrelink. Don't just submit your application and cross your fingers hoping for the best. Check in with them, confirm they've received all your documents, and ask if they need anything else from you. Be patient, but persistent. If your situation is complex, consider getting professional help. Financial counselors, Centrelink financial information service officers, and even paid advisors who specialize in Centrelink applications can help you navigate the process. Yes, it might cost some money upfront, but it could save you from a costly rejection and months of lost pension payments. Sometimes the investment is absolutely worth it. Here's the bottom line that I want you to take away from this video. The Centrelink pension system is designed to support Australians who need it, but it requires accuracy, honesty, and meticulous attention to detail. The one mistake that trips up more applicants than anything else is incomplete or inconsistent asset declarations. This isn't about trying to hide anything or game the system. It's simply about being thorough, being accurate, and understanding exactly what Centrelink needs to see from you. If you're preparing to apply for a pension, take your time with it. Don't rush through the application just to get it done. Gather everything you need first. Double-check every number you write down. Triple-check that your information is consistent across all your documents. And if you're unsure about anything, ask for clarification before you submit, rather than guessing and hoping it works out in your favor. The difference between a successful pension application and a rejected one often comes down to these small details that seem insignificant but are actually critical. You've worked hard your entire life. You've contributed to society. You've paid your taxes. You deserve to receive the support you're entitled to without unnecessary delays and frustration. By avoiding this one critical mistake, you dramatically increase your chances of getting your pension approved the first time around. If your application has already been rejected, don't give up hope. Review what went wrong, correct the errors, gather the proper documentation, and either reapply or go through the appeals process. Many rejected applications are eventually approved once the issues are properly resolved. The key is understanding what went wrong and fixing it the right way. Remember, knowledge is power. Now that you know the number one mistake that causes most pension rejections, you're already ahead of thousands of other applicants who are going into this process blind. You can prepare properly, submit a complete and accurate application, and get the pension support you need and deserve. Don't let a preventable mistake stand between you and your financial security. Take control of your application, get it right the first time, and secure your future. If you found this video helpful, please hit that like button and subscribe to my channel for more tips on navigating Centrelink and getting the government support you're entitled to. Drop a comment below if you have any questions or if you want me to cover specific Centrelink topics in future videos. I read every single comment and I'm here to help you through this process. Thanks for watching, and I'll see you in the next one.